All right. So you sent over a really fascinating stack of articles and research here
Hmm.
on something that I think we all wrestle with,
Oh, yeah.
fear and greed when it comes to investing.
Absolutely.
It's like these emotions are just hardwired into us, just
Yeah.
ready to sabotage our best laid plans. And what I really want to get out of this deep dive with you is to kind of move beyond, just acknowledging that fear and greed exist.
Yeah.
How do they actually play out in the markets?
Yeah.
How do we make decisions based on logic and not just like those gut reactions that
Yeah.
we sometimes get?
That's a great question because I think, let's face it,
Yeah.
we've all felt that pang of regret
Oh, yeah.
after maybe we made a hasty buy or a hasty sell.
Oh, totally.
And the interesting thing is that
Yeah.
our brains are actually wired to feel the pain of a loss
Mm-hmm.
more strongly than the pleasure of a gain.
Huh.
So this is what's called loss aversion, and it's a really powerful force in investing.
Oh, wow. Okay, so that explains why selling an investment, and,
Right.
even if it's for a small profit,
Yeah.
can feel so much worse than missing out on like a much bigger gain,
Yeah, it's
if
like,
we
oh,
just like held on.
that's right.
And I know I've fallen into that trap for sure.
Yeah.
But holding too much cash out of fear,
Hmm.
that can hurt us in the long run too, right?
Absolutely. So think of it this way.
Okay.
Imagine somebody who stashes all of their money
Mm-hmm.
in a savings account, earning maybe 1%,
Mm-hmm.
you know,
Right.
terrified of the stock market.
Yeah.
Over time, inflation is going to slowly erode their purchasing power.
Right.
They might feel safe,
Mm-hmm.
but their money's actually shrinking.
Yeah, it's almost like they're on a sinking ship,
Right.
but they're too afraid to jump into a lifeboat, that could
Yeah.
actually take them to safety.
That's a great analogy.
Okay, so we've got fear kind of keeping us on the sidelines.
Right.
But then there's its mischievous cousin, greed, that desire for those quick outsized returns.
Yeah.
I mean, that can be intoxicating, can it?
It can be very intoxicating, and it often leads people to chase, the latest trends,
Mhm.
whether it's pouring money into meme stocks or, jumping into some new hot sector
Yeah.
without really understanding the fundamentals.
Right. And this reminds me a lot of the dot-com bubble,
Oh, yeah.
back in the late
Oh,
90s.
the dot-com bubble.
Yeah. Early 2000s, yeah.
Everyone thought those internet stocks would just skyrocket forever.
Or ever, right.
What was it like to be an investor during that time?
Oh, it was a frenzy.
Yeah.
I mean, people were buying into companies with no earnings,
Right.
no profits,
Crazy.
just a catchy .com name.
It's just the name.
It was pure speculation driven by FOMO.
That fear of missing out.
Fear of missing out.
Yeah.
So, yeah, it was a crazy time.
So what happened when that bubble burst?
Well, when the bubble burst, about $5 trillion vanished.
5 trillion
Yeah.
with a T.
With a T, just like that.
Companies with no solid business model
Mm-hmm.
just disappeared.
Oof.
Amazon, on the other hand,
Yeah.
lost 90% of its value,
Wow.
but it ultimately recovered because they have strong fundamentals.
Yeah.
And it's a stark reminder, I think,
Yeah.
that true investing is about owning a piece of a business,
Yeah.
not just gambling on price movements.
That's a crucial distinction for sure.
Yeah.
But speaking of market crashes, how does the 2008 financial crisis
Oh, right.
kind of stack up against the .com bubble
Yeah.
in terms of fear and greed?
Well, in 2008, it was really fear that dominated.
Oh, really?
The market plunged nearly 50%,
Wow.
and panic selling was rampant.
Yeah.
But remember, the S&P 500 ultimately recovered.
Right.
And those who held on or even bought more during the downturn
Mm-hmm.
ended up with some pretty incredible gains.
Yeah.
And this brings us to a really interesting concept,
Okay.
contrarian greed.
Contrarian greed. Have you heard of that?
I haven't. Is that about going against the crowd?
It is exactly when everybody else is panicking.
That's right.
Okay. Okay.
A great example of this is Warren Buffett.
Oh, yeah.
He's famous for his value investing approach,
Mm-hmm.
buying undervalued companies
Uh-huh.
during the 2008 crisis while everyone else was selling.
Yeah.
He was investing billions
Wow.
in companies like Goldman Sachs and GE.
Wow.
He saw opportunity where others saw only danger.
He was essentially being greedy when everyone else was fearful.
He was.
Wow. And it clearly paid off handsomely for him.
Oh, it did.
But I imagine that takes incredible amount of discipline and conviction
It does.
to go against the tide like that.
Yeah.
So how can we, as individual investors,
Right?
start to harness this idea of contrarian greed
Yeah.
without, making reckless decisions?
Well, it all starts with having a clear long-term strategy
Okay.
and understanding your own emotional triggers, Okay. What are your financial goals? What are you investing for?
Right.
Having a defined plan really helps you stay focused and avoid those impulsive, emotion-driven moves.
So instead of getting caught up in the day-to-day market noise, we need to kind of keep our eyes on the prize, our ultimate goals, whether it's retirement or buying a home or funding our kids' education.
Absolutely.
But what about those moments when, fear or greed starts to creep in and we're tempted to make a rash decision?
Yeah.
What can we do in those situations?
Well, one simple but powerful technique
Okay.
is what I call the 10-second rule.
The 10-second rule, okay.
Before you hit that buy or sell button, especially if you're feeling a surge of emotion, just pause for 10 seconds.
Okay.
And ask yourself, am I acting out of fear or greed right now?
It's like taking a deep breath.
It is.
Before jumping into the deep end of the pool.
Right.
It gives our rational brain a chance to catch up with our emotional impulses.
Yes.
Okay, so the 10-second rule, that's a great tool for staying in control. But what about developing some ground rules for our investing approach? I've heard you talk about the importance of having like a set of personal investment rules.
Yeah, setting rules can be incredibly helpful.
Right.
It's like creating a personal constitution for your investing decisions.
Yeah.
So for example, you might have a rule that says, I will never put more than 10% of my portfolio in individual stocks.
Right.
Or I will rebalance my portfolio every 6 months, regardless of market conditions.
So it's about taking the emotion out of those decisions.
That's right.
Creating a framework that kind of guides our actions.
Exactly.
Even when the market is going haywire.
Yeah.
Are there any other strategies that we can use to kind of build that emotional resilience, especially, for someone who's prone to panicking when the market dips?
Well, one of the most effective techniques is dollar cost averaging.
Okay.
Have you ever felt overwhelmed trying to time the market perfectly?
Oh, gosh.
Buying low and selling high.
All the time.
Well, dollar cost averaging takes that pressure off.
Okay.
It's simply investing a fixed amount of money at regular intervals.
Okay.
Regardless of what the market is doing.
So it's like setting up a recurring payment.
It is.
For your investments.
Exactly.
So let's say you decide to invest $500 every month into an S&P 500 index fund. You just keep doing that.
That's right.
Month after month, year after year.
Yep.
You're not trying to guess the best time to buy or sell.
Exactly.
You're just staying consistent.
You're just staying consistent.
And over time, this approach can smooth out your returns and reduce your overall risk.
It does. When prices are low, you're buying more shares. When prices are high, you're buying fewer shares.
Makes sense.
It's a disciplined way to build wealth without getting caught up in those emotional highs and lows.
It's like taking the guesswork out of investing and just trusting the process.
Exactly.
But what about diversification?
Oh, yeah.
How does that fit into this puzzle of managing fear and greed?
Diversification is essential.
Okay.
It's the age-old wisdom of not putting all your eggs in one basket.
Right.
Imagine if your entire portfolio was invested in tech stocks back in 2000.
Oh, yeah.
When that dot-com bubble burst,
yeah,
you would have been wiped out.
That would have been rough.
It would have been devastating.
So it's about spreading our investments.
That's right.
Across different asset classes, stocks, bonds, real estate, maybe even a little crypto.
You'll get it.
To reduce our exposure to any single risk.
Exactly.
It's like having a safety net in case one part of our portfolio takes a tumble.
That's right.
But how do we know how to allocate our assets across these different categories?
Well, that's where a good financial advisor can be incredibly helpful.
Okay.
They could assess your risk tolerance, understand your financial goals, and help you create a portfolio that's tailored to your specific needs.
So it's not a one-size-fits-all approach?
It's not.
It's about finding the right mix of investments that aligns with our individual circumstances and goals. But before we dive deeper into some specific diversification strategies,
sure,
I want to kind of circle back to something you mentioned earlier.
Okay.
The importance of studying history.
Ah, yes. History is a treasure trove of insights for investors.
Okay. But I have to admit, sometimes studying history, especially financial history, it can feel a bit dry and academic.
It can.
How can we make it relevant and engaging for ourselves as investors?
Well, it's all about finding the stories.
Okay.
And the human element.
Okay.
Read biographies of legendary investors like Warren Buffett or Benjamin Graham.
Right.
Dive into books that recount major market bubbles and crashes, like The Big Short by Michael Lewis.
Oh, yeah.
Which tells the story of the 2008 financial crisis.
Yeah. So instead of just memorizing dates and numbers, it's about understanding the human drama and decisions that people made and the consequences of those decisions.
Exactly.
It's about learning from the mistakes and the triumphs of those who came before us.
Absolutely. And, history shows us that markets are cyclical. They go up, they go down, but over the long term, they tend to trend upward. Did you know, for example, that the S&P 500 has historically risen in 7 out of every 10 years?
Wow, that's an encouraging statistic.
It is.
But it's easy to lose sight of that long-term perspective when we're in the midst of a market downturn, and fear is kind of gripping our hearts.
It is.
It's like that old saying, when the tide goes out, you discover who's been swimming naked.
That's a great analogy.
And it highlights the importance of another key concept, defining your why.
Yes.
We talked about having a long-term plan, but it goes deeper than that.
Right.
Why are you investing in the first place?
Yeah.
What are you ultimately working towards?
It's about getting clear on your motivations.
Yeah.
So if the market takes a nosedive, and you're tempted to panic and sell everything, you can remind yourself why you're in this game. Exactly your investment goals. And the reasons behind them are you saving for retirement? Are you dreaming of buying a vacation home? Putting your kids through college? Connecting your investments to these deeply personal goals can help you stay grounded when those fear and greed monsters start whispering in your ear.
It's like having a mantra to repeat when the market throws a curveball.
Yeah.
It reminds us that, we're not just playing a numbers game.
Right.
We're working towards a future that we're excited about.
Exactly.
And that sense of purpose can make all the difference.
It can.
When it comes to making those tough decisions, especially when the market is testing our resolve.
Absolutely.
This has been an incredible start to our deep dive.
Yeah.
I mean, we've covered so much ground.
We have.
From understanding the psychology behind fear and greed to exploring practical strategies for staying in control and developing that long-term perspective.
Absolutely.
But I know we've only just scratched the surface.
We have.
What else can we look forward to in part 2?
Well, in the next part, we'll delve deeper into this whole cycle of market emotions.
Okay.
We'll explore how investor sentiment ebbs and flows. And we'll uncover even more practical tools and techniques for mastering our psychology in the face of market volatility.
Right.
We'll even introduce you to the fascinating Fear and Greed Index.
Ooh, I can't wait for that.
And
stay curious, stay informed, and remember, the greatest investor you'll ever meet is the one you see in the mirror.
It is.
Mastering your own psychology is the key to unlocking long-term success in the markets.
Could not agree more.
Okay, so we've laid the groundwork, I think, for understanding how fear and greed can really mess with our investment decisions. We've got our 10-second rule in our back pocket.
Right.
We're thinking long term.
Yeah.
And we're starting to get comfortable with this whole dollar cost averaging thing. But I'm curious, is there a way to kind of predict when these emotions are most likely to sort of hijack our brains in the market?
That's a great question, and it leads us to a fascinating concept called the cycle of market emotions.
Okay.
Think of it like a roller coaster ride.
Oh, boy.
There are periods of exuberance, even euphoria, when prices are soaring. Everyone feels invincible.
Right.
And then inevitably there's a downturn.
Yeah.
Fear kicks in. People start panic selling.
The classic boom and bust cycle. It's like watching a crowd go from cheering to screaming.
It is.
In a matter of moments.
Yeah.
But if we know this cycle exists, can we actually use it to our advantage?
Absolutely.
Yeah.
Recognizing where we are in the cycle can help us make more rational decisions.
Okay.
So, for example, when the market is peaking, everyone's shouting, buy, buy, buy.
Right.
That's often a time to be cautious.
Okay.
It might be a good opportunity to take some profits off the table or to rebalance your portfolio.
So instead of getting swept up in the hype, we can kind of step back and say, okay, things are getting a little frothy here.
Yeah, a little too hot.
Maybe it's time to take a breather.
Exactly.
But how about when the market is tanking and everybody is screaming, sell, sell, sell?
Yeah.
That's when fear can really paralyze us.
That's when it's crucial to remember that markets are cyclical.
Okay.
Downturns are a normal part of the process. And historically, the best buying opportunities have often occurred during periods of maximum pessimism.
Really?
But think back to the examples we discussed earlier.
Okay.
The 2008 financial crisis, the dot-com bubble, the COVID-19 crash.
Yeah.
Each time the market ultimately recovered and went on to reach new highs.
It's a reminder that sometimes the best thing to do is nothing at all.
It is.
Just ride out the storm and trust that the market will eventually rebound.
Exactly.
But I have to admit, it takes a lot of courage and conviction to stay the course.
It does.
When everyone else is running for the exits.
It does, but that's where having a clear why comes in.
Right.
When you know what you're investing for those long-term goals, it's easier to tune out the noise and stay focused on the bigger picture.
Stay the course.
And this brings us to another helpful tool for gauging market sentiment.
Okay.
Have you heard of the Fear and Greed Index?
The Fear and Greed Index I have, but I'm not exactly sure how it works.
Okay.
Is this like a crystal ball that tells us what the market's going to do next?
Not quite a crystal ball.
Okay.
But it can provide some valuable insights.
Okay.
Essentially, the Fear and Greed Index tracks a variety of factors.
Okay.
Like stock price movements, market volatility, even social media sentiment, to measure whether investors are feeling overly fearful or greedy at any given time.
So it's like taking the pulse of the market's emotional state.
Exactly.
But how can we actually use this information to make better decisions?
Well, extreme readings on the Fear and Greed Index can often signal potential turning points in the market.
Okay.
For instance, when the index shows extreme fear, that might be a good time to consider buying.
Interesting.
As prices may be undervalued.
Okay.
On the other hand, when the index shows extreme greed, it might be a good time to be cautious.
Okay.
And consider taking some profits off the table.
So it's like that famous Warren Buffett quote.
Yes.
Be fearful when others are greedy.
Right.
And greedy when others are fearful.
That's exactly right.
But it's important to remember that this index is just one tool in our toolbox.
It is.
We shouldn't base our entire investment strategy on it.
Absolutely. It's important to use it in conjunction with other research analysis and your own personal risk tolerance.
Okay.
Now let's talk about some additional strategies for beating fear and greed.
All right.
We touched on dollar cost averaging earlier, but what about developing a more comprehensive rules-based system?
A rules-based system?
Yeah.
What exactly does that entail?
Think of it like establishing a personalized constitution for your investing decisions.
So it's like creating a set of commandments for my investment.
You can think of it that way.
Okay.
It involves setting clear, predefined rules for buying, selling, and managing your portfolio. So, for example, you might have a rule that says, I will rebalance my portfolio every quarter to maintain my target asset allocation.
Right.
Or I will not sell any investments during a market correction of less than 10%.
So it's about having a set of guidelines that takes the emotion out of the equation when the market's going haywire.
Yeah.
I don't have to panic and make impulsive decisions.
No.
I just follow my rules.
That's the idea.
But creating this system, it seems like it would require a lot of upfront work and discipline.
It does. But the payoff can be significant.
Okay.
It can help you avoid those costly emotional mistakes
Right.
that can derail your long-term goals.
Yeah, that makes sense.
And remember, your system doesn't have to be overly complex.
Okay.
Start with a few simple rules and gradually add more as you gain experience and confidence.
That's a great point.
Yeah.
It's about building good habits and developing a process that works for you.
Absolutely.
Now, we've talked a lot about preventing ourselves from making emotional mistakes.
Yeah.
But what about when we have already made a bad decision?
Right.
Driven by fear or greed?
Yeah.
Is there any way to kind of recover from those missteps?
Well, one of the best things you can do is to view those mistakes as learning opportunities.
Okay.
Analyze what went wrong, what triggered your emotional response, and how you can avoid making the same mistake in the future.
So instead of beating ourselves up,
Right.
we can actually use those experiences to become better investors.
Exactly.
Turn those lemons into lemonade.
There you go.
But it's hard to admit when we've made a mistake.
It is.
Especially when it comes to our money.
Yeah, it can feel very personal.
Yeah.
But remember, everyone makes mistakes.
Righty.
Even the most seasoned investors.
That's comforting.
The key is to learn from them and move forward.
Okay.
And this brings us to another important point.
Right.
The importance of seeking guidance and support when you need it.
Yeah. That's a great point. It's easy to feel isolated and overwhelmed
Is.
when we're trying to navigate the markets on our own.
Yeah.
But there are resources available to help us, right?
Absolutely.
Okay.
You'll be afraid to reach out to a trusted financial advisor or mentor.
Okay.
They can provide objective advice, help you develop a sound investment plan, and offer support during those challenging times.
It's a reminder that we're not alone in this journey.
That's right.
There's a whole community of people who are passionate about investing.
There is.
Eager to share their knowledge and experience.
Absolutely.
But I have to admit, sometimes the sheer volume of information out there, it can feel overwhelming.
It can.
It's like trying to drink from a fire hose.
It can be like drinking from a fire hose.
Yeah, so how do we even begin to make sense of it all?
That's why it's important to be selective about the sources you trust and to focus on building a solid foundation of knowledge. Start with the basics. Understand the different asset classes. Learn about risk and return. And develop a framework for evaluating investment opportunities.
So it's about building our investing IQ gradually, brick by brick.
One step at a time.
Rather than trying to absorb everything at once.
That's right.
But even when we've got a solid foundation, it's still easy to get caught up in the emotional roller coaster of the market.
Absolutely. It's human nature.
So are there any practical tips or techniques that we can use to kind of stay grounded and maintain perspective?
One of the most powerful practices is simply journaling.
Journaling. I thought that was more of a self-help thing.
It can be a great tool for self-discovery, but it can also be incredibly valuable for understanding your own emotional patterns and triggers.
So if I'm feeling anxious about the market, I can write about it in my journal and try to identify that's driving that anxiety.
That's right.
Okay.
You can also use your journal to track your investment decisions, both good and bad, and reflect on the lessons you've learned.
It's like having a personal record of our investing journey, including both our triumphs and our missteps.
Exactly.
But sometimes it's hard to be honest with ourselves.
Yeah, it can be.
Especially when we've made a mistake.
It can feel like admitting defeat.
Yeah.
But remember, the goal is not to be perfect. But to learn and grow by acknowledging our mistakes.
Yeah.
We can identify our blind spots, develop strategies to overcome them, and ultimately become more disciplined and successful investors.
So journaling can help us turn those investing fumbles into valuable learning experiences.
Absolutely.
I love that this has been a fantastic continuation of our deep dive. We've explored the cycle of market emotions, discovered some really helpful tools like the Fear and Greed Index, and delved into practical strategies for building a rules-based system. And even using journaling to enhance our self-awareness. What else can we look forward to in part 3?
Well, in the final part, we'll explore this concept of balance. Finding that sweet spot between respecting fear and tempering greed. We'll also discuss some strategies for teaching others about managing market psychology. And we'll leave you with a powerful call to action that will empower you to take control of your emotions and achieve your financial goals.
Sounds like a perfect way to wrap up our deep dive. But until then, stay curious, stay informed, and keep those emotions in check.
Absolutely.
Okay, so we've explored, a ton of strategies, for kind of navigating this emotional minefield of investing. We've got our rules, we're journaling, we're even checking that Fear and Greed Index. But it still feels like there's this tightrope walk, between respecting fear enough to avoid, those stupid risks, but not letting it paralyze us, And then keeping that greedy goblin, on a leash. So we don't chase every hot stock tip. How do we find that balance?
It's a skill that takes practice, but it's essential for long-term success in the markets. Think of fear as like a built-in alarm system. It's there to protect us from danger. But sometimes it goes off when there's no real threat.
So like that smoke detector that always seems to go off when I'm making toast. Annoying, but better safe than sorry.
Better safe than sorry. In investing, fear can warn us about things like having too much debt, not having an emergency fund, or concentrating our investments in a single sector. It reminds us to be prudent to do our research and to not bet the farm on a risky venture.
So we should listen to fear's warnings, but not let it kind of dictate our every move.
That's right.
We need to find a way to acknowledge it, assess the situation, and then make a rational decision.
Precisely.
Okay.
And when it comes to greed, it's all about setting boundaries.
Okay.
Think of it like training a puppy.
All right.
You need to establish clear rules and consistently reinforce them
Okay.
Investing those rules might involve things like taking profits at predetermined levels.
Okay.
Not chasing speculative investments or sticking to a predetermined asset allocation.
So we're setting up guardrails to keep ourselves from veering off the road and crashing into a ditch.
That's a great way to put it.
It's about acknowledging that greed is part of our nature.
It is.
But it needs to be channeled in a productive way.
Absolutely.
Okay, now let's shift gears a bit and talk about something that's often overlooked. I think teaching others about managing market psychology.
Yeah.
This isn't just about protecting our own portfolios, right? It's about empowering those around us to make smarter financial decisions.
Absolutely.
And I think that's a great point because, you know, we've all got friends or family members
who
might be prone to making, you know, those impulsive investment decisions.
Yes.
But how do we even approach these conversations, you know?
Yeah.
Without sounding like preachy know-it-alls.
That's the challenge, right?
Yeah.
It's about meeting people where they are and tailoring your approach to their level of understanding.
Okay.
So for beginners, you know, focus on the basics. The power of compound growth, the importance of diversification, the dangers of trying to time the market.
So instead of bombarding them with complex financial jargon, we start with those fundamentals and help them build a solid foundation.
Yeah. And remember, storytelling can be incredibly effective.
Okay.
Share your own investing experiences, both the good and the bad, and highlight the lessons you've learned along the way.
It's about making it personal and relatable.
It is.
Showing them that, hey, we're all human.
Right.
We all make mistakes.
And that we can learn from them.
Yeah. Now, what about teaching kids about managing market psychology?
Oh, that's a great question.
I mean, it might seem daunting.
It can be.
But it's so crucial to instill, you know, those good financial habits early on.
It is, absolutely.
But how do we make these concepts engaging for kids, you know, who might be more interested in video games than stock charts?
Turn it into a game.
Okay.
Create a simple stock market simulation where they can practice investing with pretend money.
Fun.
Or use an allowance system to teach them about budgeting, saving the trade-offs between spending and investing.
So it's about making it fun and interactive.
It is.
Showing them that investing can be exciting. And empowering.
Exactly. And as they get older, you can introduce more advanced concepts like risk and return, diversification, the importance of long-term thinking.
So we're planting the seeds for financial literacy and helping them develop a healthy relationship with money from a young age.
Absolutely.
Now, as we wrap up this deep dive, you know, I want to bring it back to what we all want to achieve, making smarter investment decisions and building wealth over the long term.
Absolutely.
What's the one key takeaway that you want our listeners to remember?
The most important lesson, I think, is this successful investing is not just about numbers. It's about mastering your psychology. It's about understanding how fear and greed can influence your decisions and developing strategies to stay in control.
It's like we've been on this journey of self-discovery, you know, exploring the inner workings of our minds and how they interact with the external world of the market. And this is an ongoing process, right?
It's an ongoing process.
We're all constantly learning and evolving, and there will always be new challenges to navigate.
There will be.
But armed with the knowledge and strategies that we've explored in this deep dive, I think we're much better equipped to face those challenges head on.
Absolutely.
And achieve our financial goals.
Yes.
So the next time you feel that urge to buy or sell an investment, take a moment to pause, reflect, and ask yourself, is this decision driven by fear, greed, or logic?
That's the question.
It's a simple question, but it can make all the difference.
It can.
By mastering our psychology, we can become the masters of our own financial destinies.
Couldn't say it better myself.
Thanks for joining us on this deep dive. Until next time, happy investing.